Central banks have stepped up moving gold out of London and New York to reduce geopolitical and access risks. So there's a whole bunch of stuff going on here. They want their gold accessible to themselves, and especially, as we've seen, the need for first-tier gold, the only hedge against for a central bank, to in some cases be instantly liquidated for the need to create dollars. So in other words, the perfect hedge, the hedge that gold was always designed to be. Even though that's over at this point, the 24th of July closure date lines up with the SGE connected Hong Kong gold clearing system launch. That's not a coincidence. We also suspect the White House is watching this date very, very closely. China now has the infrastructure required to challenge the entire COMEX LBMA price setting regime and effectively greenlight a global central bank revaluation event. This is a date to watch, and really, it's really going to force the Fed's hand.
Gold is quietly shifting across the world, and the implications could be enormous. A little noticed change may reshape how nations protect wealth and power. Andrew Maguire highlights a growing movement by central banks to relocate gold reserves from London and New York into domestic vaults or trusted regional hubs. He argues that governments increasingly want direct access to their bullion as geopolitical risks rise and confidence in traditional financial arrangements weakens. Gold remains a critical hedge, offering liquidity during periods of stress and serving as a strategic reserve asset when rapid access to funding becomes necessary. Maguire also points to the upcoming launch of the Shanghai Gold Exchange connected Hong Kong clearing system, suggesting its timing alongside key market developments is unlikely to be accidental. According to his assessment, China is building the infrastructure needed to challenge the long-standing COMEX and LBMA pricing framework. He believes these developments could encourage a broader revaluation of gold by central banks worldwide and place additional pressure on the Federal Reserve. For investors, the message is clear. Watch these dates, trends, and signals carefully. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Now, this Financial Times piece highlights global central banks no longer trust storing their physical gold in New York or London. Remember, this was a conspiracy theory. We're all making this up. There you go. I mean, okay, Financial Times used to not be a friend of gold, and they're not a friend of gold, but they are reporting what is in your face, basically. And so following the last 3 months of geopolitical uncertainty, central banks are stepping up efforts to repatriate their sovereign assets. And with gold having overtaken US Treasuries as the top reserve asset, as trust in dollar-based systems weaken, the shift proves gold is being treated as strategic sovereign asset, not just a reserve holding. Now, as we drew attention to last time, central banks have stepped up moving gold out of London and New York to reduce geopolitical and access risks. So there's a whole bunch of stuff going on here. They want their gold accessible to themselves, and especially, as we've seen, the need for first-tier gold, the only hedge against for a central bank, to in some cases be instantly liquidated for the need to create dollars. So in other words, the perfect hedge, the hedge that gold was always designed to be. So at least, and that's, even though that's over at this point, they want to have that accessible to themselves naturally. And if you don't trust that it's somewhere, that it is in place, then you sincerely need to bring it home. As we looked at last time, India and France are amongst the biggest recent repatriators, with France 100% storing all its gold domestically. Now, we get a lot of questions around rehypothecation. So let's actually put them to rest. In broad terms, hypothecation is simply the act of a borrower pledging gold bullion as collateral to secure a loan, but they retain ownership of that gold. So that's straightforward. However, rehypothecation occurs when a lender takes that pledged gold collateral and they use that same asset to secure its own loans or obligations. And at that point, two or more parties hold claims on the same gold bar. So read the Fed rehypothecating US Treasury physical gold is what we've been looking at as this, over the last 60 years, basically. And that is precisely the issue at hand now. As a paper-to-paper rehypothecation analog, it's not too dissimilar from the Lehman Brothers bankruptcy, where, if you remember, 22 billion, or it was about 55% of the 40 billion in client assets, was completely subject to competing ownership claims. However, while that episode resulted in Lehman's bankruptcy, which was ultimately settled with freshly printed cash bailout to staunch what was really a wider rehypothecation that could have taken down all the too big to fail taxpayer-funded banks and the insurance companies that were insuring those positions, that then led to the 2008 banking crisis. Bearing in mind that Lehman had rehypothecated it, and other banks had also rehypothecated. So they were the fall guy, and it was leveled for cash as a bailout. However, resolving gold rehypothecations requires the physical metal itself to be made whole. It can't be printed away. The gold must either be bought back at a market price, which would clearly tighten supply at the same time and risk spiking the price higher, or defaulted on, which is pretty much unthinkable in a global marketplace, or revalued. And with the Fed's gold liability settled accordingly. So what do you think they're going to do here? It's going to be revalued. Thinned out paper market liquidity evidences the Fed's 60-year gold short is running out of road. You may not think it when you look at the action, but if you step back, that is exactly what's happening here. Now, we've previously examined the Fed US Treasury rehypothecations in much more granular detail, and the empirical trail points to an unknown portion of the $8,100 tons of US Treasury gold being either absent or rehypothecated. I mean, no one knows exactly the extent of it. But this leaves the Fed confronting the consequences of a deeply underwater, multi-decade bet against gold, one that must now be marked to market as repatriation pressures are intensifying. This is all the pieces of the puzzle are there to see. There's just not enough immediately deliverable above ground bullion for the Fed to simply buy its way out at scale at any price. Now, this leaves one viable exit, a paper gold revaluation from $42.22 to the market price. We kind of discussed what that might be last time. Now, we'll look at this on the chart shortly, but the end of June, of the June Bank of International Settlements gold squaring effort. This is where the Fed borrows gold from the Bank of International Settlements and then has to repay it. This was marked to market yesterday. Now, it looked like the Fed's final attempt to cover as much short exposure as possible before an impossible to escape revaluation event. But in driving the synthetic overshoot below physical support levels, the Fed stepped on some very, very large toes.
Recent developments in the global financial system continue to draw attention to the growing role of gold as a strategic asset. Around the world, central banks are increasing their focus on asset security, reserve diversification, and long-term financial stability. Amid economic uncertainty, geopolitical tensions, and currency volatility, many institutions are reassessing where and how they store their gold reserves. This trend reflects a broader shift towards strengthening sovereign control over critical financial assets while reducing dependence on external custodians. Gold's reputation as a reliable store of value has made it an important component of reserve management strategies, particularly during periods of market stress and policy uncertainty. Analysts note that the movement of physical gold reserves and the continued accumulation of bullion by central banks highlight the metal's enduring significance in the international monetary landscape. These developments offer valuable insights into changing priorities across global finance and into the evolving approaches to risk management, asset protection, and economic resilience. Let's get back to the interview.
The 24th of July closure date lines up with the SGE-connected Hong Kong gold clearing system launch. That's not a coincidence. We also suspect the White House is watching this date very, very closely. China now has the infrastructure required to challenge the entire COMEX LBMA price-setting regime and effectively greenlight a global central bank revaluation event. This is a date to watch. And really, it's really going to force the Fed's hand. Also noting gold is held by 82% of central banks, and gold has moved to the center of reserve management strategies. The end game is clear. A gold-banked RMB is a direct challenge to dollar reserve dominance. It gives reserve managers a hard asset benchmark against debt-backed dollars, and it creates a credible alternative settlement reference point. Don't forget, the RMB, the yuan, is exchangeable one-to-one with gold. The RMB currently carries some obvious other constraints, though. It includes capital controls, so people just poo-poo it and say, well, it's just not going to work. But Beijing, they forget that Beijing spent years building the workaround of at least 40,000 tons, if not 45,000 tons of gold that can bridge mainland physical gold with internationalized, collateralizable, high-quality liquid asset gold. And that's why the beta-tested Enbridge platform matters. Do you remember we did a lot of work on Enbridge some years ago? And China is pushing it towards commercial rollout as a central bank digital currency rail, which is designed really to make cross-border payments faster, cheaper, and less dependent on dollar settlement. Now, if you recall, Enbridge began as a Hong Kong bank and Thailand initiative. It was a combined initiative. It became Enbridge in 2021. We did work on this when the Bank of International Settlements had a finger in the pie, and the central banks of Dubai, China, and the UAE joined in the Enbridge platform. But under Fed pressure, the Bank of International Settlements had to step back in 2024. And this is just about the time that the Shanghai Futures Exchange launched. And what they did was hand the project, the Bank of International Settlements handed the project to the partner central banks that we just mentioned. Now, the platform lets central banks transact directly in their own digital currencies. This is key, cutting foreign exchange settlement times, ready to seconds, and reducing the need for the dollar as an intermediary currency. So bottom line, Enbridge is not just payments plumbing, its strategic monetary infrastructure is built to accelerate the digital RMB adoption. It's going to create a lower cross-border payment costs. It's going to support China-aligned trade, and it's going to push the global payments system further into a multipolar architecture, which is exactly many, many times we've talked it. London Paul, and many of our guests we've been discussing this with over the years. So inside the 100% physically backed SGE gold corridor, this rail can steadily reduce reliance on dollar-based gold settlement while expanding RMB use in China-linked trade, RMB gold-backed use in China-linked trade. Now, that is the unfactored dollar risk, a credible challenge to dollar-centered settlement that reinforces the long-duration de-dollarization bid for gold and other non-sovereign reserve assets. And as it's internationalized, zero counterparty risk gold-linked settlement gains traction. It's going to gain traction. It's bound to gain traction against what? Riddled first-tier treasury demand? And that's coming under pressure, as we just indicated. And there's lots of reports of that, not just Financial Times, but many of the other reports illustrate this. So the US will actually be forced to defend dollar credibility. Well, how's it going to do that? Now, as we outlined last time, once competitive remonetization between China and the US accelerates, a gold revaluation becomes the cleanest balance sheet response. So a credible gold-backed RMB would really simply going to puncture the dollar's reserve monopoly. I mean, the dollar dominates because it remains the deepest, most liquid settlement asset right now. But July's launch of the PBOC's physically backed Hong Kong gateway starts to change that by giving reserve managers a hard asset benchmark against dollar paper, essentially. So a Chinese gold anchor is simply going to expose the dollar's lack of monetary backing. The US dollar is supported by treasury depth, military power, tax capacity, and the network effects of that, but not by convertibility into a tangible reserve asset. A gold-backed RMB would make that contract explicit. And unless the US revalues gold, it will face a reserve confidence problem. So if central banks, commodity exporters, and trade surplus nations begin to diversify into gold-linked RMB instruments, which they will, the marginal bid for US treasuries will weaken. And we're seeing that already, raising funding pressure on Washington. That's clear. They've got to join the party. As it's been for the last 6,000 years, gold will restore itself as the neutral referee between currencies. And once major power credibility links it links its currency architecture together to gold, markets would begin comparing other currencies in gold terms rather than purely through interest rate spreads or bond yields. Back to 6,000, what's been happening for 6,000 years, what the Fed tried to dissolve in 1971. So the US basically will have three really choices. You kind of ignore it. Well, it ain't going away. And defend the dollar with higher rates. Well, really? That's going to pressure US debt sustainability. Or really, what are they going to do? Revalue gold upwards to strengthen the dollar's balance sheet credibility? May be simpler. What we're saying is this inevitable gold price reset really leads to just one inevitable question. How are you positioned? Are you positioned well ahead of a gold and silver price reset? I hope so.
The global financial landscape is entering a period where long-standing assumptions are being tested by new infrastructure, shifting reserve strategies, and changing approaches to monetary stability. Whether these developments unfold quickly or gradually, the signals coming from central banks, sovereign reserves, and international settlement networks suggest that the next chapter of the monetary system may look very different from the one investors have grown accustomed to over the past several decades. What matters now is paying attention to the mechanisms being built behind the scenes rather than focusing solely on daily market noise. Major financial transitions are rarely announced with a single headline. Instead, they emerge through policy decisions, strategic reserve management, and structural changes that gain significance over time. As these trends continue to develop, staying informed and understanding the broader context could prove more valuable than reacting to short-term volatility. The months ahead may provide greater clarity on how governments, central banks, and global markets adapt to this evolving environment. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.